Lesson 12: Controlling. This chapter focuses on the controlling aspect of catering management, which involves implementing control techniques to safeguard the organization's financial stability. Effective control relies on understanding potential areas of financial loss, allowing caterers to tighten operational procedures. This function is integral to the overall organizational plan and aims to ensure business survival and mission fulfillment through the strategic integration of control techniques into every event planning process. After studying this chapter, you should be able to 1. Describe the control function in catering management and its necessity for business success. 2. Explain why managing organizational resources is a critical catering management task. 3. Describe the process of control, including information gathering and performance monitoring. 4. Explain the need for both internal and external control features within a catering management system. 5. Explain why the control function is often overlooked and the potential consequences. And 6. Explain how internal techniques guide employee behavior towards achieving predetermined objectives. Controlling resources is crucial for a catering business's financial health, achieved through financial tools and standards integrated into all management functions. Effective control involves comparing actual performance against planned objectives, requiring both internal and external control features. Internal controls focus on managing food, beverage, and labor costs, particularly prime costs. Cost control procedures are essential for timely information acquisition, enabling informed operational decisions. Ultimately, a caterer's success hinges on enforceable controls, efficient food and beverage management, and strong budgetary objectives derived from robust accounting systems. Lack of control. Small catering businesses often struggle with long-term success due to inadequate control measures. Caterers, frequently operating as jack-of-all-trades, may lack specialized management support, requiring them to personally oversee all functions. This time constraint can lead to neglected control, as it's an ongoing process rather than a discrete task. However, overlooking control procedures during operations sends a detrimental signal to employees, potentially resulting in revenue loss. Elements of control. Control in catering begins with establishing internal techniques that guide employee behavior towards achieving specific objectives. By delegating bundled tasks, caterers rely on these control techniques to ensure employees work effectively without constant supervision. Multiple meanings of control. The controlling function in catering encompasses several key aspects: establishing standard operating procedures for task execution, implementing objectives aligned with the organization's mission, integrating management functions into event plans, protecting assets, money, food, equipment, and ensuring efficient asset utilization for profitable product creation. In essence, it's a multifaceted process that guides employee behavior, safeguards resources, and drives profitability. Process of control. The control process in catering emphasizes acquiring timely and relevant information for informed decision-making. This information aids in setting fair market prices and researching menus for both business and client benefit. Secondly, it facilitates the creation of achievable standards and operating procedures, crucial for implementing plans like hazardous analysis critical control points. Lastly, continuous monitoring of events, comparing actual performance against predetermined objectives, is essential for identifying and quickly rectifying any operational defects. This immediate correction, based on appropriate financial information, is vital for the catering operation's immediate and long-term success. Cash flow. Maintaining a consistent cash flow is essential for a caterer's financial stability, requiring a formal payment policy to ensure timely client payments. Traditional post-event invoicing has evolved to accommodate corporate payment schedules, often stretching to 60 to 90 days, which can strain cash flow. To mitigate this, caterers should implement structured payment policies, such as requiring 1/3 payment at contract signing, another third before or on the event day, and the final third within 30 days post-event. More stringent policies demanding full payment before the event are also recommended to cover pre-event expenses like food purchases and staffing. These policies ensure prompt payment, guarantee a steady cash flow, reduce financial stress, and contribute to business success. Clients must agree to these terms up front, providing the caterer with financial security. Pricing the event. Determining event pricing in catering is a flexible process, varying based on caterer-specific calculations and client needs. Caterers may offer all-inclusive packages with tiered menu options or employ diverse pricing methods. The three primary methods are cost-based pricing, which adds a markup to calculated production costs, client-based pricing, which sets prices based on the client's perceived value of the event, and competitive-based pricing, which mirrors market rates. Additionally, market skimming pricing involves setting high prices to maximize profits in specialized markets, while market penetration pricing uses low initial prices to gain market share. Cost-based pricing requires accurate expense calculation, including overhead indirect costs, and prime costs direct labor and food. Client-based pricing adjusts prices based on perceived value, like special services or amenities, allowing for varied pricing. Competitive pricing aligns with market standards. Market skimming can attract competition due to high profits, and market penetration requires high volume to compensate for low prices. Determining the cost of a catering event begins with the menu, as different menu items significantly impact profit margins. Standardized recipe cost sheets are essential for accurately calculating these costs. Additionally, caterers must consider all expenses associated with executing the event, including transportation, labor, and equipment logistics, especially for off-premise catering. Quoting a flat price for the entire event requires a comprehensive understanding of all involved services, such as food delivery, equipment retrieval, and post-event cleanup. Client expectations and budgets also play a crucial role in pricing, as clients may have varying perceptions of value depending on the type of event and menu. While food costs differ between events like breakfast and luncheon, fixed expenses such as labor and transportation remain consistent. Each event must be priced individually, considering factors like entree selection, which significantly affects the overall cost per person. Furthermore, additional factors like the event's duration, appetizer service, and soup or salad courses must be factored into the final price. Caterers determine event pricing based on per-person costs, encompassing fixed transportation, labor, and food expenses, with financial goals tailored to each function. Building a loyal clientele relies on fair pricing, excellent service, and trust. However, unforeseen factors can impact profitability, necessitating detailed post-event analysis to prevent future losses. Long-term contracts pose a challenge due to fluctuating market prices, requiring protective contract clauses that allow for price adjustments closer to the event. This ensures fair pricing and allows caterers to pass on savings, reinforcing their reputation. Additionally, caterers must remain vigilant for hidden costs, like increased insurance or labor, and acknowledge potential miscalculations that can erode profit margins. Professional service companies. Caterers can enhance their profitability by establishing relationships with professional service companies like photographers, florists, and rental agencies, who often offer referral commissions. Building strong, trust-based partnerships with suppliers is also crucial, ensuring fair pricing and reliable service. However, internal controls are necessary to prevent unethical purchasing behavior, such as collusion and kickbacks, which can compromise the company's assets. Employing trustworthy buyers and implementing a clear code of ethics are essential safeguards. A written code of ethics, communicated to all stakeholders, guides individual behavior and prevents misunderstandings. Promoting ethical conduct within the organization. Professional associations provide valuable networking opportunities for caterers to share experiences, discuss industry challenges, and explore creative solutions. The financial component. Financial management is crucial for caterers, involving resource acquisition and utilization to maximize operational efficiency and owner wealth. This includes forecasting financial needs, securing external funding, and implementing robust accounting systems. External funding can be obtained from money markets, short-term, or capital markets, long-term, through equity or debt financing. Equity financing involves stock issuance, retained earnings, or depreciation, while debt financing uses borrowed funds with repayment schedules. The accounting function provides timely and accurate financial information for decision-making. Accounting systems summarize business transactions, generating reports for tax purposes, creditor communication, investor information, and internal operational decisions. These reports are essential for absentee owners to assess management performance. Key financial reports include the balance sheet and income statement. The balance sheet provides a snapshot of the business's financial condition at a specific point, detailing assets, what the business owns, liabilities, what it owes, and owner's equity, the owner's investment. Assets are categorized as current, easily converted to cash, or fixed, long-term use. Liabilities are classified as short-term, current, or long-term. The balance sheet uses the accounting formula: assets equals liabilities plus owner's equity. The income statement reveals financial performance over a period, detailing operating revenue, sales, and expenses. It calculates net income or loss. Operating revenues minus operating expenses equals net income or loss. Expenses are categorized as cost of goods sold and operating expenses. Analyzing the income statement using percentages allows for comparisons across events, time periods, and industry standards. Caterers must establish financial goals aligned with their mission statement and maintain accurate records of food and beverage consumption. Regular physical inventories are essential for cost control and financial planning.